Everyone's been waiting for rates to drop. Headlines promised relief, but today the Bank of Canada held rates again. That's right, 7 consecutive drops following 3 back-to-back holds in 2025. The central bank has decided to pause. So what does this really mean? For homeowners, buyers, investors, buckle up because the next 24 months might be the most unpredictable stretch in the Canadian housing we've seen in decades. Hey, it's Justin Chaussee. If you're trying to figure out whether to lock in, buy, sell, or just survive the mortgage chaos, this video is for you. I've broken down the latest Canadian rate forecast, what the hold means today, and how everything from tariffs to consumer debt is settling up new waves of pressure. By the end of this video, you'll understand exactly where the risks are, how to prepare, and how to use the numbers, not just headlines, to make smarter decisions. Before we dive in, remember, this isn't just about numbers. It's about your home, your family, your future. So grab a coffee, settle in, and let's break down what's really happening in Canadian real estate. So let's start with where we are at right now. The Bank of Canada has held its overnight rate again, still sitting at 2.75%. That's the third straight hold this year. And while it sounds like we're on pause, let's not forget the journey here. Before these 3 holds, we saw 7 back-to-back cuts. And before that, a bunch of increases and holds. The market has been on a roller coaster, and every move or lack of one sends ripple effects through our economy. Inflation data is still sticky. The housing market is soft in some places and hot in others. Most experts can't agree what's coming next. Some say we're headed for a soft landing, others warn of a correction, and a few even predict a rebound. Now, zoom in on homeowners. If you bought between 2020 and 2022, you're probably rode a low rate wave. Maybe you went variable thinking that rates would stay low, or you locked into a fixed rate at 1.9%. Either way, renewal is coming, and it's coming with pain. Some of these homeowners are now staring down a 99-year amortization just to keep payments flat. Yes, that's real, and no, it's not sustainable. Imagine signing up for a mortgage that outlives you, your kids, and even maybe your grandchildren. It's a sign of just how stretched things have become. Meanwhile, the cost of borrowing hasn't just doubled, it's tripled in some cases. If you have a $500,000 mortgage at an interest rate of 1.9%, your payments were manageable. Now, if you're sitting around 4.5% or 5% or more, it's a different story. For many, it means tightening belts, cutting back on spending, and even considering selling. And it's not just homeowners feeling the squeeze. First-time homebuyers are facing higher qualification hurdles, investors are recalculating returns, even renters are impacted as landlords pass on the higher costs. So here's where the friction gets worse. Tariffs are still here. Trump's re-election in the US has already brought new tariffs that will affect manufacturing, supply chains, and inflation north of the border. Higher costs means higher consumer prices, and that could stop the Bank of Canada from cutting rates anytime soon. Think about it. If the price of goods keep rising, the central bank's hands are tied. They can't risk fueling more inflation. Then there's household debt. Canadians are more leveraged now than ever. The average household debt to income ratio is at a record high. If rates don't fall soon, we could see an increase in defaults, not because people bought recklessly, but because life got too expensive fast. Groceries, gas, insurance, utilities, everything is costing more. And when your mortgage payments jump by hundreds or even thousands per month, something has to give. And don't forget about appraisals. Pandemic buyers in places like Toronto, Vancouver, and even Calgary paid $80,000, $100,000, or $150,000 over asking in bidding wars. Now, their homes are appraising below what they paid for. That gap, it could stop them from home ownership or refinancing. Imagine needing to renew your mortgage only to find out that your home isn't worth what you owe. It's a tough spot, and it's becoming more and more common. Even investors are feeling the pinch. Rental yields are down, expenses are up, and new rules in provinces like Ontario and BC are making landlords more complex. Vacancy controls, rent freezes, and strict protection means it's not easy to raise rents or evict non-paying tenants. At the same time, property taxes and maintenance costs keep climbing. And here's the kicker. Despite all of this chaos, we still have a housing shortage. Immigration targets remain high, construction costs are up, and developers are delaying new builds. It's a perfect storm. Demand keeps rising, but supply isn't keeping up. That's why even with higher rates, prices in some markets aren't falling as much as you'd expect. So let's talk about the emotional side for a moment. If you're a homeowner, you might feel trapped, unable to move, refinance, or even renovate. If you're a buyer, you might feel priced out or worried about catching a falling knife. Investors are questioning whether real estate is still the safe bet it once was. And for renters, the dream of home ownership feels further away than ever. All of this creates uncertainty, and uncertainty breeds caution. People delay decisions, wait for clarity, or hope for a miracle rate drop. But as we've seen, the Bank of Canada isn't in a hurry to make these changes. So here's what economists are saying. If inflation cools, the global market stabilizes. We could see 5-year fixed rates settle around 4.25% by the end of 25. That would bring some relief, but it's still more than double the rates we saw just a few years ago. But if geopolitical shocks like tariffs or oil spike prices persist, rates could stay elevated into 2026. That means higher payments, tougher renewals, and more pressure on the markets. There's no clean trend line here. Every rate decision is data dependent. The Bank of Canada is watching inflation, employment, global events, and consumer spending. One bad inflation print, one global shock, and the outlook changes overnight. But what's clear is this: we're not going back to 1.99% interest rate. Those pandemic rates are gone, and they're gone permanently. If you're waiting for ultra low rates to return, you might be waiting forever. The new normal is higher, and we all need to adjust. So what can you do about all of this? Run your numbers. If your renewal is within the next 6 months, don't wait. Lock in a rate hold today. It doesn't cost you anything and it gives you leverage. Even if rates drop, you can always renegotiate, but if they rise, you're protected. Get an appraisal. Knowing what your home is worth right now helps prepare you for refinancing or pulling equity. Don't rely on online estimates or hearsay. Get a professional opinion so that you know where you stand. Consider a HELOC or a home equity line of credit. Even if your home is paid off, I 1000% recommend having a home equity line of credit in place. You don't need to use it, but in uncertain times, it's better to have access to capital before you need it. Think of it as an insurance policy for your finances. And here's a bonus tip. Talk to a mortgage professional. Don't go at it alone. The rules are changing, the products are evolving, and what worked last year might not work today. Get advice tailored to your situation. If you're feeling overwhelmed, I totally get it. This isn't just about rates. It's about your lifestyle, your investments, your retirement plan, and the wrong decision today could cost you thousands. I'll personally pull a free home equity report for you or walk you through your options in plain language. No fluff, no pitch, just honest advice. Hit the link below and get clarity today. Remember, in a market like this, knowledge isn't just power, it's protection. Thanks for watching, and I'll see you in the next video.